Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending September 2nd. Taking a look at the markets for the week, all mostly down on the week, so let's dive into the charts and take a look at what we're seeing. Starting out with the Bitcoin chart, actually down a little bit less than the traditional markets, but also down on the week and just hanging out just below the 20,000 mark. Looks like it's been chopping around between about 20,400 and about 19,500 in a very tight trading range, likely looking like a bear flag. We'll likely head lower from here, looking for a retest of the lows we had in June, which were right around 17,600. I think that's likely where we're heading next, and could very well head lower from there, but we'll be looking for how the market reacts on the Bitcoin price once it retests those June lows to see where it heads from there. But for now, still looking for the Bitcoin and cryptocurrency space broadly to head lower. And then take a look at our S&P 500, the SPY chart. A little bit more of a sell-off in the markets. We did see it hit some resistance at that 390 level we talked about, as it would likely act as support. Did act as support there, but then opened up all the way back up to the 50-day moving average on Friday, and then sold off pretty aggressively right all the way back down to that 390 level. Did hold the support just a little bit, but that price action is looking pretty bearish, and since it's failed off of that 50-day again, I think we're likely heading lower and heading down to retest those June lows, which on the SPY would be right around 362. So I'll be looking for price action to the downside in the markets as well. Take a look at our NASDAQ chart, the triple Qs. Similar story here. We did try to get back up above the 50-day, and that failed, and now we headed lower quite a bit on Friday, closing out the week on the triple Qs at about 295. Looking for that to likely go back down to our June lows, which would put the triple Qs back down to about 269, 270, and then we'll see where price action takes us from there. And then take a look at our Dow Jones Industrial Averages. Also got up pretty close to the 50-day as a possible test, and it did break down from that level all the way back down to our Fibonacci extension level at about 311.60 on the DIA, and looks like we're likely headed lower to test those June lows, which on the DIA would be about 296. And then take a look at our Dow Jones Transportation Average Index. We talked about last week how we had tested that Fibonacci extension level as support at 14,360. Probably expected it to break down going into this week, which it did, and it sold off quite a bit, now sitting at about 13,737. So it looks like we're likely heading to the downside in the transports as well, and I would think potentially that 200-week moving average could be a potential area of support to watch for, or possibly our anchored VWAP. Both of those are at pretty similar levels, so we'd be looking at somewhere around 12,200 to about 12,450 on the Dow Jones Transportation Index for the downside target. And look at our Russell 3000 chart. We did break down this week below that center channel line, as we had previously broke back up above that level, retested the 50-week moving average, and then started heading lower. We've had pretty consistent sell down on the Russell 3000 for about 3 weeks in a row. Next level of support I'll probably be looking for is that 200-week moving average, but I am very much expecting this price action to take us all the way to this bottom channel here at some point on the Russell 3000. And then we've got our IWB, our large caps. Get that pulled up here. So IWB broke down off of that 231.15 level probably about a week and a half ago, it looks like. Let's get this onto the weekly chart here, and there we go. So we're about 2 weeks now. We've been sitting up below that Fibonacci extension level at 231, selling off more on large caps, so things are still looking pretty bearish for our large caps, and I'd be looking for a possible downside target right around that 200-week moving average, which looks like it'll probably put it right at around the 200 level on our IWB for large caps. And then take a look at our small cap chart, IWM. We are very close to our 200-week moving average. We'll see if that holds up as support, but my guess is that if it does act as support, it will probably be fairly short-lived, and that I would expect that we'll probably head lower from here. We'll be looking at that 173.50 level, which will also likely act as support, but it wouldn't surprise me if we saw a complete breakdown from that level. And if we do, The next levels to the downside I'd be looking at would either be this anchored VWAP position at 161 or possibly as low as 144 on the IWM. And then we look at our growth versus value chart. We can see that growth has been had a nice little run, but for about the last 4 weeks now, it's been starting to rotate, and so value is starting to outperform growth, and we're coming pretty close up against some key support and resistance levels right around that 1.53 level, which is also the 200-week moving average on this chart. So we'll see if that holds the support. If it doesn't, my guess is there's a good chance we'll head lower from there, and that would tell us that I think value over growth is going to be the place to be in the short term. And then when we take a look at our sector review, taking a look at all these different sector ETFs that we watched to see the health of the market, where the best outperforming sectors are, taking a look at the last 2 trading weeks. The only thing we can see in the green right now is our agricultural fund up 1.4%, energy's up 0.6%, but has been selling off quite a bit. And then also the XOP is just down negative 0.2%. All the other sectors are down on the last 2 trading weeks, anywhere from about 2% in the red all the way up to about 10-11% in the red. Our worst performing sector is the semiconductor space, down almost 12%, technology and robotics ETF down 10%, cloud computing and technology down 10%, as well as online retail, traditional retail, global auto index fund, quite a few sectors down, close to double digits in the last couple of weeks. So it's definitely been a tough couple of weeks to be long. We've been sitting short and on the sidelines in cash mostly. If there is a sector to keep your eye out for, it could be energy. But as we're going to take a look at with this oil chart, there's also a chance that the energy trade might be dying off, at least in the short term as well. And when we take a look at that, our U.S. oil chart has had a pretty major change from previous weeks. We are now sitting, have a close below this channel line, which really has not been broken up until that was going all the way back to the COVID crash back in April of 2020. So that's a pretty substantial trend line break where we have not seen a weekly candlestick close below that level until last week, and then going into this week, it looks like we are still staying below those levels, also below the 50-week moving average. And so there's a decent chance that we might see a sell-off in oil, and if that happens, I don't think you want to be super long on a lot of energy stocks. If we see a break below, I'd call it about 85 on the U.S. Oil chart, then I think we'll likely head lower from there. And if we do break down below that 85 level, I'm thinking maybe right around the $66 to maybe $76 a barrel could be some areas of support on our gas prices. If we do see a drop below that, that is good news at the pumps, but don't want to be probably long energy in that situation. So if I'm going to get super bullish on energy again, I'd like to see the oil price get back up above that 50-week moving average, which currently is sitting at about $93 a barrel. And it doesn't look like we're heading that way right now, so as long as we're below that, then I'm not really looking to get too long in the energy trade right now. And then when we take a look at our CRB commodity index, obviously oil is a part of that, but it's just a piece of the commodity space. We can see that commodities broadly sold off this week as well. It did resist up against the center channel line. Did not break up above that. If we saw a break above that center channel line, that would have been very bullish for the commodity space, but we actually saw the reverse of that this week, and we saw a pretty aggressive sell-off. So I'll be looking for a retest of this bottom channel line, which also coincides with our 50-week moving average, and we'll want to see what price action does from there. If we see a complete failure below this channel line as well as the 50-week moving average, then I'd be getting pretty bearish in the commodity space, and that'd probably be good news for the inflation story, but definitely not good news for commodities if we see that develop. So keeping a close eye on that one over the next week or two to see where we go from here in the commodity space. And when we take a look at our consumer discretionary versus consumer staples, we can see that we resisted at that 0.74 level and then started selling off, and so we've been going down for about 3 weeks now in this chart, and so people are getting more defensive. Consumer staples are starting to outperform consumer discretionary, which makes a lot of sense when the markets are selling off. And when we take a look at our all-world ex-US, so this is the global markets minus the United States, not a lot of excitement there either. Clear downtrend still continuing, and we're likely to head lower. We'll see if we can hold support at that 47.50 level, but my bet is that we'll probably only hold that as support briefly, and once we do break that, then we're likely headed lower, and the next level would be targeting to the downside on the VEU would be $44 roughly. And then taking a look at our high yield corporate bond ETF, we blew through this last week below the 75 level, so that's pretty bearish for the high yield corporate bond ETF. Likely going to test this former lows in June, which was right around 72.73 on the HYG, and I'm guessing that we'll likely head lower from there. The previous sell-off we had during the COVID collapse, we saw HYG go all the way down to about 67.50, and I think that's probably my bet is that we'll retest those levels on the HYG and potentially head lower, but that 67.50 would probably be a level I'll be looking at for a downside target on the high yield corporate bond ETF. And when we take a look at it on relative terms, taking a look at high yield corporate bonds versus traditional treasury bonds, we can see that we're still kind of in this trading range. If we see a breakdown below that 0.73 level, I think that'll be a warning sign that the markets are likely to sell off further, but we haven't seen that quite yet. And then jumping over to the gold and silver space, we saw gold retest the 200-week moving average this last week. This could be an interesting long-term buy level once we, now that we're touching that 200-week moving average. I still think there's a decent chance though that gold could be chopping around in a range for a while, and it's obviously possible that we could see it not hold support on that 200-day or 200-week moving average as well. So right now I'm probably just kind of sitting on the sidelines with gold, keeping an eye on it. Probably like to see it break above 174.50 before I get more bullish on gold right now, but for now it's looking like it might be holding support on that 200-week moving average. And then taking a look at silver. Silver's in much worse shape than gold is because it's already well below the 200-week moving average. It did go up and retest that, but then it failed and rolled over from there. We're now sitting at about $16.50 on the silver price per ounce, and we'll see. We've got some, it looks like some volume support right around those levels. If we do head a little bit lower on silver, I could see it maybe going as low as about $15.50 or so. Would be fairly surprised if we saw a break below that $15.40, $15.50 level. But we'll keep a close eye on that. Definitely not looking for any long positions in silver right now with that price action. And then take a look at our interest rates, starting with the 2-year. 2-year looks like at end of the week at about 3.385%. Looks like it's starting the next week out, heading up to the upside. Definitely looking like rates are moving to the upside across the board. Taking a look at our 10-year rates, we can see that they're sitting at about 3.23% right now. Looking like they're challenging that former close high at about 3.27. I'm expecting we'll likely head higher from there, and if we do, we could be heading quite a bit higher on the 10-year, potentially maybe as high as 4%, maybe 3.5%. We'll just have to keep a close eye on that, but I think 3.5% to 4% on the 10-year is possible, especially if the Fed keeps tightening into the slowing economy. I think the rates can continue to head higher for a while. And then take a look at our 30-year. We closed the week out on the 30-year, sitting at about 3.35%. Looks like we're starting out the next week heading a bit higher as well. So we'll see if we can break above that 3.47% level. That was the previous highs on the 30-year back in November of 2018. So it'll be a key level of support and resistance to watch for. If we do see a break and a close above those levels, then it would look like we'll likely be heading higher from there on the 30-year. And then taking a look at our yield curve, our 10s minus 2s, we're still in the negative on this one, looking at about negative 0.23%. We did have a bit of a rally off of these lows that were previously sitting at almost negative 0.5%, but we'll see where we head from here. We're still in a pretty clear down channel trend line, and that'll likely act as resistance, and I would expect we'll probably head lower on the yield curve in the future. And then taking a look at our VIX. The VIX had a bit of a spike over the last couple of weeks. We're now sitting at above 25 on the VIX, so a little bit of elevated volatility in the markets, especially over the last couple of weeks where we were sitting closer to 20, and definitely thinking that we could head higher from here on the VIX. Wouldn't surprise me to see us get back up above 30 at some point, and if we do, that'll likely be coinciding with some more market pressure. And then taking a look at our put-call ratio, we are in elevated put-buying protection right now. Anything above 1 is elevated put-buying protection. We've seen some pretty extreme levels recently. We've seen a couple of days where it's actually been above the 1.25 level, and so people are definitely being cautious in the markets and buying protection. And then we'll go ahead and close it out with the dollar chart, the DXY. I've been saying for quite a few weeks now, I think this is one of the most important charts on the market. If the dollar's going up, Bitcoin's likely going down. and it's oftentimes a pretty tough tailwind or headwind for the markets rather. If the dollar's heading up, and it looks like it is continuing to head that direction. Looks like it's hitting up a little bit of resistance at that 110.40 level. We break up above that level though, then it looks like we'll be heading higher, maybe looking for the next price target right around 115 on the DXY. But as long as that dollar is in an uptrend, then that's likely bad news for the markets. And so keeping a close eye on this DXY chart. If we see a sharp rollover in the dollar, that'll likely coincide with some bullish opportunities in the market. But right now, things are heading pretty aggressively to the upside on the dollar, and so I'm not really looking for a lot of longs in this market condition. Thanks for tuning in this week. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. And make sure to like and share the video, and we'll see you next time.